Hey everybody, I want to welcome you all to our summer edition of a webinar covering 1031 exchanges. We'll go through a couple of topics on how 1031 exchanges work and how Doorvest can help in the process. Of course, I'm not a 1031 expert, and so for that, we've brought a real expert in. Just want to introduce Mia Sweeney from First American Exchange. So you guys are really fortunate today. Mia is a seasoned expert in the real estate industry with a focus on 1031 tax deferred exchanges. So she's the business development manager for First American Exchange Company in the Pacific Northwest. She's been in the business for about 35 years, experience across the board in title, escrow, transactions, brokerage, and 1031 exchanges. And she's really known for her ability to simplify complex tax issues, which you'll get a taste of today in this webinar. Mia is also a licensed real estate instructor and a highly sought-after speaker and educator in her field. So whether it's a forward, reverse, or built-to-suit exchange, Mia and her team are super well equipped to help guide you and her clients through the process. Additionally, Mia is also available to provide continuing education classes and workshops on 1031s upon request. So Christian,
Thank
do you
you.
mind if we advance the slide and just for the quick agenda, and then I'll hand it off to Mia. Thank you,
Right,
Mia.
awesome. Perfect. Thank you, Mike. That was awesome. And welcome everybody that's here today with us. So summertime, it's always good to learn a little few more things. So obviously as the agenda, what is a 1031? We're going to talk about capital gains, 1031 requirements, timeframes, financial requirements, same taxpayer requirement, all these things we're going to kind of dive a little deep in, and you're going to go away. We're not going to expect you to know everything, but we're going to know you to see, oh yeah, this is an opportunity, or this is something I need to know a little bit more about. And then we'll have Q&As at the very end, because we're going to talk about how Doorvest can help in a 1031 exchange. That's a great tool. So let's go to the next slide. So 1031 tax deferreds exchanges. So 1031 is a powerful tool. It's one of the biggest levers to building your real estate portfolio. You're going to exchange out of one property and you're going to buy up or buy more properties or diversify your real estate, investment portfolio. So how this really works is I guess one of the basic benefits you're going to get from this is you're deferring paying your capital gains tax. All right. And you're disposing of and acquiring a like kind properties. Now we're going to go into that a little bit of detail, but I'm going to just say right now, like kind just means real estate investment for another real estate investment, real estate for real estate. So it can be, a single family home, multifamily. It could be multifamily commercial. So we'll talk a little bit more. I've got a great visual, but I just want you to know that you're investing real estate for real estate. You have to hold it for investment purposes or business use. And part of that means, how did you file it on your taxes? How are you using this property? And then following the 1031 rules. That's where we come in as a qualified intermediary to kind of help everybody stay in the right lane, discuss if we're going to go down that avenue. A lot of times we're going to say you might want to talk with your CPA. These are the questions we maybe need to be discussing. So we can go to the next slide. So capital gains is a taxable income from selling an asset for more than its basis, the adjusted cost. We'll go to the next slide. So here's a good example of capital gains tax. The sales price is 1 million. Now you bought it for 300,000. And so the gain on that is 700,000. Next slide. So here kind of breaks down the math and what can happen here. So your gain is 700,000. Federal capital gains tax, depending on your income, is 15 to 20%. Okay, now there could be state tax. It depends on what state that you are in. I believe we only have 11 states that do not have state tax. So, that is something that's going to definitely come into play in most states. Medicare tax, now that's another one. Depends on what your annual income is, whether that Medicare tax is going to hit you or not. But if you receive a big gain, that's going to bump you up as income, and you most likely are going to get hit with that Medicare tax. All right. So on this example we have here, they're looking where, the estimated total tax is 131,600 or 193,200. And we even talked about the depreciation recapture. So you can see why a 1031 is such a great tool to leverage. And if your goal is to buy more real estate, why not 1031, right? So, and of course, down here at the bottom, depreciation recapture is 25% of the total depreciation taken. So, and this can, I don't want to go down that avenue and get in the weeds because every property is different. Every property has its own story, and every investor has a different goal. So that's why, creating your team is super important. And, having a CPA on board, having your investment team, and having, just knowing the right people to kind of bring aboard to ask the right questions and know if this is the move you're going to make. How usually what you're going to do is you're going to find the baseline and go, yeah, this is why I need to do this. So we'll go to the next slide. So Internal Revenue Code, Section 1031 requirements. So that's what we're going to talk about right now. So what it must be an exchange. That means that, you're in exchange is we're selling one property, relinquishing, and we're going to replace it with another property, right? And one of the things, we'll kind of go into this a little bit, but one of the things I like to say for people to remember is IRS would like you to mirror your investment or greater. So if you sold something for 800, they want you to go back out in the market and buy something for 800 or greater. All right. And like kind property is used for investment or business purposes. So again, meaning it's real estate for real estate. And but it can be, like I mentioned earlier, you can go single family to commercial or mini storage or multifamily. So you can you can diversify your investments. It's built for you to build that real estate portfolio. Now, the other important thing, and this is what causes a lot of, I would say, anxiety sometimes for some sellers, is the 45 days to identify and 180 to close. So the 1031 clock does not start ticking till the day after your relinquished property closes. So we're doing this today is July 25th. If you closed on a property on July 30th and the first is is your day one. So I'm sorry, I'm backing up. If your close date was a July 30th, that's the date that the deed is recorded and funds are wired. So then that following day would be your day one of your 1031 clock would start ticking. So you have 45 days to identify your replacement property and 180 days actually close on that transaction. So that's 6 months. All right. Why the 45-day identity period is so important is because IRS says whatever is on that list is on that list. We cannot change it after day 45. That's okay. I mean, that's fine. We're going to make it easy. We give you a worksheet, to fill out, and our team is right along with you through the whole process to help you, stay and keep in the right guidelines. But day 45, and usually most of my investors are under contract before day 45, and that first property they're going to list is going to be one that they're already under contract on, and then the other properties are their backup properties. All right. And one of the cool things about Doorvest is that you guys have lots of properties that are ready to go. They're turnkey. So I love that opportunity for everybody. So and then the 180 days to close, that's great because sometimes if it's commercial, there might be some, and we've got financing, there might be just some hurdles or environmental studies or, there's just gonna be things that might need to happen to get that done or new construction. And again, just like I talked about earlier, has to be equal or greater in value. And you want to make sure that you match that sales price or greater. If you had debt that got paid off on that relinquished or sold property, you want to match that debt over in your replacement property with cash or another loan. And it can be seller financing. It doesn't matter. Just need to make sure that that settlement statement shows that. And the other really important rule, which gets really complex sometimes, is the same taxpayer rule. The way to always think about this is that if you own this property and you're filing it on your taxes with this tax ID number, when you buy your replacement property, needs to be the same taxpayer ID. We can't change things up. Think of it like a daisy chain. It needs to be the same. Otherwise, you're going to cause a red flag for IRS, and nobody wants that, right? So we'll go to the next slide. 1031 exchange terms, you kind of have already heard me kind of rambling these on. Relinquished is the property you're selling. A replacement is the property you're purchasing, you're buying. And a qualified intermediary is what we do. And we'll kind of talk a little bit about what we do and how our role is. We just are going to make sure everything is done according to the IRS codes. All right. And then boot is another important one, because boot is what we call, which is any cash that you take ahead of closing that you may keep, that will be considered boot. That would be a partial exchange. And you can totally do that, but it is taxable and you're going to be subject to the capital gains depreciation recapture. Same thing on the back end. If you do not match that sales price, if you buy under, if you don't match everything, there's that will be boot, and you could be taxed on that. And then also not matching like that debt could also be boot. It's considered boot and can be taxable. So again, that's why you want to have your team all on board, be clear and know what your numbers are. And, we kind of help you ask the right questions. Go to the next slide. So creating an exchange. So first of all, when we come aboard, when you're relinquish the property you're selling, once you have it under contract and escrow's been opened, then that's when we'll prepare exchange documents and then send them over to you to sign, and then we'll work with your closing. To back up a little bit, what I want to say is that you can never start the 1031 conversation too early. Absolutely know that. You can never ask too many questions with 1031. And so that's, just know that you can ask questions. We're going to set it up once you're under contract on your relinquished property. And then, once you have that property that you're selling under contract and you have a closing date, you actually can start shopping for your replacement property. Okay. And this is a great opportunity to kind of be ahead of that 45-day closing. And literally, a lot of times I'll have somebody who's closing on a property on August 1st, and we're closing on their sale, and we're going to close on the replacement property on August 5th, so we don't even hold their funds very long. Now, this is an important thing. What the QI does is that we're going to make sure that those funds are held. We call it sometimes like parking your funds. And it's going to be, because you can't control the funds. Once you have funds, once you've received those funds, then you're going to be taxed on the funds that you received. So if you closed and you have cash and escrow sent you funds, it is too late to do an exchange. So I guess that's the important thing. You start when the property is under contract, and it's too late if you closed already. All right. Oh, wait, go back to her one more time, just back. And so funds are held in a separate bank account for you. They are an account under your name and your tax ID number, and they are fully insured. FDIC is to 250, and we make sure that your balance, that full amount, is insured. Okay, now we go to the next slide. Okay, perfect. So this is like kind, and I love this one because it's a really great visual here. You can sell raw land and go into single family. Going single family to raw land is a little more complex, and we would have a talk about that one, making sure the math works on that one for you. Apartment building for a retail center, office building for a warehouse, a fourplex for a tenants in common interest into an office building. So that's an important thing I want to make a note here, is that, remember when I talked about the tax ID number and daisy chaining that and keeping the same tax ID payer there? What you want to do is you cannot go into a partnership with somebody and buy in that way. You always, so let's just say, Mike, you have something, you have a complex, maybe like some units, 4 different buildings, and you're going to sell me a quarter of that. I can't just join you. You're going to need to sell me, like 25%. So I would buy from you as tenants in common an undivided 25% interest in this. I would just own, it'd be, Mia Sweeney as a 25% interest as tenants in common, with Mike Jew as to undivided 75%. Now, that could be LLCs, but we want to make sure that we are keeping our daisy chain consistent, okay? And then it gets kind of also complex too, sometimes if we have an LLC and the partners want to go different ways, which is common, and we just need to plan ahead for that. That's just something that you want to definitely talk to your CPA. We get everybody all on board and make a plan, because this changes your tax situation. So we always need to have those discussions in the front of being listed, I would suggest. All right, let's go to the next one. What is not like kind? Now, this is really sometimes easier to remember. So, it must be an investment property or a property used, for business purposes. It says here receiving rent, but it doesn't always need to be an income producing property. Just know that you need to be definitely claiming this correctly on your taxes. A personal residence does not, you cannot use a 1031 on a personal residence. And that's probably one of the most common questions and misunderstood rule. Vacation homes, as a rule, don't work. But if it was set up as a like VRBO and you're following the 1031 safe harbor rules, that can work. And I feel like a lot of things with 1031 and IRS is that there's some IRS law are written ambiguously, and there's kind of some gray area, so it can be interpreted differently. It's always safe to say a vacation home doesn't usually work, but if it is set up in the rule where that it's been owned for 2 years, minimally rented out for 14 days a year for 2 years, your minimum use was 14 days, and it's insured and properly ran, sometimes those properties can work just fine, but we also want to make sure that your CPA is on board and you've done all your documentation correctly. Held for sale, dealers like builders, those usually do not work. And fixers and flippers usually do not work. And here's part of that too, is that they don't own that. Well, they may own the property, but it hasn't been up, it hasn't been an investment for rent, being held long enough to be a rental property or an income producing property. And think about like this as one thing, that if it's less than a year and a day, then that's short term. All right. And after a year and a day that you've owned it, then it becomes capital gains, and depreciation and recapture can all come and hit you. So again, it's one of those kind of gray areas, but it's pretty clear if you're a builder or you're a flipper, you're not going to qualify for a 1031 exchange. And dual purpose properties, again, another one of those gray areas. If your property, like we'll have farms, wineries, like maybe sometimes there's a triplex or fourplex and a seller lives in one unit and then the other, 3 or 4 are rented. That can work, but you do need to make sure that it's been allocated on your taxes correctly, so that you can make this program work for you. All right. And then stocks and bonds and partnership interest, again, that is not part of a 1031. At one time, 1031 law has been around since like the 1920s, and it's changed throughout the years. I mean, we actually used to be able to exchange vessels and airplanes, but real estate for real estate, the only thing we can do now. All right, I'll go to the next one. So timeframes, this is, again, we're talking about that 45 and 180 days. This is a really great slide. Oh, wait, we're just going to go to this one first. Yeah. So 45 identification needs to be in writing, has to have the address. And if it's like vacant land, we need to probably at least have the tax parcel number with the county and the state. And what we also say is we have the 3 property rule, and there's called a 200% rule and 95% rule. The 3 property rule, and we're going to give you worksheets to align with what your goals are. The 3 property rule is the most common and used by all of my investors, small, big, medium, large, because you can identify up to 3 properties no matter what the value is. All right. And then there's the 200% rule. So if you sold something for 500K, then you could identify something up to $1 million. You cannot go over that. So, and then the 95% rule, I don't ever see that. And it doesn't always work out. So I wouldn't even just go into that one because it's not really a feasible option, but it does work for certain situations. And again, we provide you a worksheet that you fill out. I always say don't turn it in till just before the 45th day, just because the market always changes and you want to always be keeping your eyes wide open until the very end. And it's really important to identify, like 3 properties. We've had crazy things happen, to have a tree go through a house. We've had a flood or, just something, had a fire on one. So you want to make sure that you have a backup plan, and this is what ensures that. All righty. And then the 180-day to exchange is at 6 months. Okay. So from the day after closing, you have 6 months to close on that transaction. And if you go after that, then it's going to be in a failed exchange. And there we go. So here's the timeline. Perfect. So day 1, like again, or day 0 is closing of the relinquished property. So that day 0 is the deed was recorded and funds were wired from escrow or from the attorney. So day 1 is the day after closing. And then day 45 is your identification period. So you're hunting hard for 45 days. I mean, even if you go under contract on day 3, I still want you to keep your eyes wide open so that you know that you're capitalizing on this opportunity. And then the timeline, we have another one that's going to show the 180th day is on the replacement property. Now, these timelines, there are no extensions. Even if the deadline is a Saturday or Sunday or a legal holiday, we go by IRS calendar days. And so and only time that there is a delay is that should there be some kind of natural disaster, like we had some fires or flooding or hurricane, and it is by letter and approval of President of the United States. So that's the only time that we really have those extensions. All righty, let's go to the next one. So financial requirements is kind of the basics here. So to be a fully tax deferred exchange must be, remember before I said equal or greater in value, right? And then you need to also have equal or greater in the equity. So that you invest all of your net proceeds of the exchange into that replacement. You can bring in cash or you can bring in new debt. But I always say whatever's on that settlement statement of the property that you relinquished or sold, you want to match that or greater on that replacement property. And that's for a fully tax deferred. Here we are is exchanging for equal value, but reduced equity. Okay. And this is creating some boot. So the value is 300. The replacement property is 300. The loan is 100. They have a loan for 150K. The equity is 200, but the equity is 150 here. We'll go to the next one. And this one shows no boot because they sold for 300. They bought for 400. Their loan was 100, but they bought for 200. The equity was 200 and the equity was 200. The other slide before that was just showing basically like if you were to buy something like vacant land and it doesn't have a structure on it, thank you. That's where you can find yourself in a little bit of a predicament there. So anyways, we'll just keep going back to this next slide. So same taxpayer requirement. I mentioned this a little bit earlier. And so this is so important, you guys, and this becomes so complex, the same taxpayer who transfers a relinquished property must acquire the replacement property. And a lot of times what happens is I'll have a gentleman who's single and then he gets married and now he's owned this property for years and now he wants to sell this property and he has a spouse now and the lender wants that spouse to be owned there. So there's a lot of things that come into play. We're going to ask questions with our CPA, make sure everybody's okay with, how this is set up. And then one of the other things, a disregarded single member LLC and a sole member LLC. So I can own a property by myself and I can also have an LLC name as long as it's me, and I can purchase I can sell a piece of property as Mia Sweeney, but I can buy it under the Sweeney LLC as long as it's just a sole member LLC. That is absolutely okay. All right. And then sometimes that's where the lending part can come in to, it depends on if it's a commercial lender or residential lender. So sometimes it's good to work with an investor lender. Just they're not going to make you run through some of the hoops that a standard residential lender might, just because they're more used to working with investors. Grantor and his grantor revocable living trust. So the same thing, if I was selling a piece of property, but I had a living trust created, I could actually purchase that in my living trust or vice versa. I could sell in my trust and purchase as an individual. If a taxpayer dies during the exchange, his state or trustee may complete the exchange. That is absolutely okay. Okay. So here's a really great example for you guys. So, ABC partnership, XYZ Corp, XYZ. Now the Wilson Revocable Trust, Rick and Sue Wilson as individuals, absolutely okay. Mary Jones, sole member of the Mary Jones LLC. And John Smith, 100% ownership. John Smith can buy 20% of a tenants in common ownership. He can buy from Mike. He's going to buy from you, Mike. Okay. All right, let's go to the next one. So who can exchange? So a partnership is a separate taxpayer. So that's one thing. If it's a partnership, that partnership has to be the same. The partnership sells, the partnership buys. Individual partners can't trade a partnership interest. And if we want to do this, we call it a drop and swap, and it needs to be done ahead of time, like a few months, because you need to bring your CPA involved on this. And what happens if you have a partnership, if Mike and I have a LLC, we're partners together, and we want to go our separate ways, what we're going to need to do is that LLC, the Mike and Mia LLC, is going to need to deed to Mike as to 50% tenants in common interest, and to Mia as a 50% interest as tenants in common. Now we can do an exchange. Mike can go do his thing and invest how he wants, and then now I can go my way and invest how I want. So that's one of the ways to do that. It's called a drop and swap, but we do need to do that. I would suggest sometimes a year to 6 months, a minimum. You don't want to do it the month of because it just could create a big red flag for IRS. All right, let's go to the next one. Oh, that's it. So I think, I'll tie up a little bit before I hand it back over to you guys is, let's see, 1031, like again, I said, is one of the most powerful tools. Oh, I know. What is our role as a qualified intermediary? What we do, I'm going to roll because I've got my little list here. So we provide the required exchange agreements. We accept assignment of all of the exchange contracts. We provide notification of the assignment to all parties. We're going to work with both escrows. We furnish instructions, like I said, to that settlement or escrow or closing, attorney. We establish a qualified escrow account for your funds to be safely secure. And again, you can't receive funds. Once you receive funds, then you're taxed on those funds. We deliver the escrow funds for the settlement to your replacement property. We also can use that escrow, your parked funds, for your earnest money deposit. And that's something that not everybody knows. So you can instruct us to pull that money out of your account for the earnest money for your replacement property. And we work really close with your broker, with your closers, just to help you kind of get everything going. And we give the final accounting of escrow funds and interest earned. You're going to get a packet from us in the very end also. So you have everything you need for your tax filing. And we're always here to help. We always say we're here by your side all along the way. And we have great teams. We serve nationwide, and we have some great resources on our website also at www.firstexchange.com. And thank you.
Thank you, Mia. That's awesome. 1031 is so powerful. I feel like I learn a ton every single time, and First American, an amazing partner here. So thank you so much for that. That was awesome. Quick housekeeping item. I think some of you have bombed in some questions already. Thank you for that. See someone with a hand raised. If you don't mind, we're going to do a couple of minutes in Doorvest, so that'll give you a bit of time to put your questions into the Q&A button here on the Zoom, and then we'll get to some questions at the end. All right. So if you have questions, please put them into the Q&A if you have not already. All right, perfect. It's great to see all of you. I think 1031 and Doorvest actually make for a pretty remarkable partnership. I think there's different levels of relationship with Doorvest from some of the folks on the call and who'll watch the recording. But let's tell you a little bit about what we do. So at Doorvest, we're just working to make investing in real estate, specifically for single-family rentals, easier. We basically take care of everything from sourcing the property, acquiring and renovating it, and managing it long term. A nice thing that makes this easy in 1031 land is we'll always have an inventory of 10 to 15 properties that rotates over time. So you can look at a list of similar properties that match what you're looking for and easily fill out that 45-day list. Our properties we optimize for a long-term buy and hold. You can see some of the different characteristics from our inventory there on the right. One exciting new thing is traditionally we've done properties that are 100% renovated in the past. Over the last little bit, been able to add some new builds, which have made for some interesting opportunities. One nice thing, since we do cover the entire cycle of the process from acquiring the initial property to selling and handing over title to the final buyer and managing long term, is we're able to help shape the deal to match your financial goals here. So just very briefly, a couple items here. DV Boost, which is pretty exciting. Essentially, it's a way that Doorvest, if we're managing the property long term, is able to put some more cash back into your pocket every month, whether or not the property is occupied. Nice thing with our platform, we have all-in-one pricing, so no need to bid or haggle. We algorithmically determine what the price of the property shall be. Easy for you to do some of your replacement math and figure out if something will work or not. And we also have the option, if you really want to be incredibly hands-off, for premium property management. So that's essentially a property management type where we would have rent guarantees and renovation guarantees available sort of the entire duration of our management. Make it the next slide, Christian. So as you look at the Doorvest marketplace and the inventory, places we're looking for, no surprise for those of you who've already purchased a Doorvest property or more than one, places that are great hotbeds for real estate investment. So rapid population growth, great job growth, really important inventory at an attractive and accessible price point. You can imagine there are markets like perhaps downtown Manhattan where we would stay away from because it's less accessible to the kinds of investors we normally talk to. And we want to optimize to make sure that the final exit financials make sense for investors like you. Exciting note, we need to update this graphic, but this quarter we've also expanded our geographic footprint to include Florida. Alrighty. Taking a look, I do see some questions rolling in here. Just give us a moment to organize and collate as the man behind the curtain organizes. All right. Mia, do you mind if I read them out to you and
Yeah, that's fine.
you can give an answer? Let's see. So I have one question here. This is a great one. So I think you might have answered it lightly, but what if at closing the exchanger wants to take some cash from the sale of the relinquished property?
Yeah, that is absolutely okay. It's just a partial exchange. You want to make sure that you let escrow and your exchange officer know that ahead of time. Most importantly, you want to make sure you check with your CPA or tax advisor and say, hey, we're thinking of keeping this cash, and what's going to be my tax consequences next year of that, just so that you know and there's no surprises. So yes, you can absolutely do that. It's just called a partial exchange, and that's a great opportunity to do that is at that time. But I cannot stress enough that one, talk to your CPA or tax advisor and make sure you let the team know that you're going to keep cash. And so that will happen at closing. They'll say, what do you want to do with your net proceeds? And you'll say, I want to keep 50,000 and the rest is going to go in the exchange. and then your settlement statement should reflect that. All right.
It's awesome. So much flexibility in this tool, but I guess that's the benefit
Mhm.
of a really, really powerful tool. Okay. I can see some of the questions came in earlier as we were talking, but I will ask them regardless here. We have a question. Would doing a 1031 delay the transaction? I guess this would be either on the sale or on the acquisition side.
Yeah, and we don't ever delay. It's usually just that somebody's waiting to close. They're the relinquished property. They're waiting for that to close, to close on their replacement property. So, that would be the only thing, as their money is available to them immediately. We could actually even do a simultaneous closing. So we could receive funds, on the first, and then actually, fund their replacement property on the first. So no, and I think the only other delay would happen sometimes is when a investor decides the last minute that they want to do a 1031, and we're getting them information, helping pose questions, and they need to talk to their CPA or their tax advisor. So that's where the delays happen. But for the most time, like I said, if we start the conversation early, not a problem at all. And again, those funds do not need to be held for any particular time and can be actually, done the same day simultaneously. And just for, I always say, I come from escrow and title, and if you can give it an extra day or two, especially because you have different counties and recording, or states, because we do things state different, national time zones, it's sometimes nice to have an extra day or two on those, but we can make it happen. We just need to make sure everybody's all lined up. Good question, though.
That's a great question. And this sparks an answer from us as well, is if any of you are deciding to embark upon 1031 exchange into a Doorvest property, let us know as well. We can
Mhm.
often adjust things like close dates, coordinate with lenders, make sure everything lines up correctly. And so if
Mhm.
Mia tells us, hey, we need a day or two extra here just for buffer to make sure it goes through cleanly,
Mhm.
easy enough for us to adjust as long as we know ahead of time.
Right.
Okay, just see two more. You're right. Mia, this is a common question. I'll ask it, but since you already answered it earlier, but
Mhm.
just to hammer it home,
Yeah.
could I exchange my primary residence in a 1031?
No. No, but you know what you do get out of that? You can use the section 121 exclusion, which means that if you've owned the property for 5 years and you lived in it 2 years, out of those 5 years, that if you're married, you can write off 500 of the gain, or of the taxable. You could write off 500 of it, would not be taxed. And then if you're single, then 250 and 250K could be written off, not taxed, basically. So, and again, that you'll just like remind your CPA or tax advisor, hey, primary residence, owned it 5 years, lived in it 2. I want to use the 121 card, is what I would say. So,
Great note. All right, some more questions here.
mhm.
Mia, we have someone who's wondering, could they could somebody do a 1031 exchange into a rental property and then after 2 years or down the road decide to move into it as a primary?
Yes, absolutely. That's a great plan. I sometimes call it it's a tactic and strategy. And so, yes, you own a rental property and you move into it, and then, basically want to make it a primary residence at least for a couple years. And then again, going back to that primary residence rule of owning it 5 years and living in it 2, you might be able to actually have a combo and do a section 121 exclusion and do a 1031 if you sold it. But most people are using that for kind of their exit plan later on down the road. So they buy a property that they eventually want to live in or retire to, and so they rent it out for a couple of years and then they move into it and make it their primary residence. So it's a great plan.
That is an awesome strategy, not one that I
Mhm.
considered. Thank you for the question.
Mhm.
I have two more here, three more here. The questions are rolling in. I can see that questions are begetting questions. So I think this is a scenario question. So break out your calculator, Mia.
No.
If it's and we might need more details, and if we do, please tell
Yeah, we
us.
might. Yeah. Still go give
But
it a
I
shot.
but just to give it the shape, what if we sell a property for $2 million, where we realize a gain of $200,000? Is it possible to buy a property for $1 million where 100% of the funds roll over? I guess we would have to make an assumption if there was how much equity was on the deal. Yeah.
Well, it's still, the baseline is this. If you sell for 2 million, you got to match 2 million. You do get a little bit of wiggle room. Let's just say that your closing expenses were 200K on that 2 mil, meaning closing expenses, title, escrow, sales tax to the state, brokerage, attorney fees. You can add the exchange fees. Let's just say it's like 200K. Usually closing expenses are 8 to 10% nationwide. But so that would mean if you sold for 2 million, you'd want to buy for 1.8 million bottom line to avoid being taxed. So, that's, I mean, if you buy down, you're going to have to pay capital gains tax on that portion that's down. And then when you get into that little bit of, you know, the gain and my investment, that's when you need to bring your CPA involved, because everybody's tax hit's going to be a little different. It depends on how it's laid out. So yeah, I'm kind of deferring it back to your CPA, but I just, remind you of the basic rule to match that sales price or greater. I
Makes
hope
sense.
that was a helpful answer, and we could always reach out one-on-one on that one too.
Sounds like a great place to spin a real scenario out, talk it through, and see who we need to bring in and talk about it.
Mm-hmm.
Awesome. We'll do one or two more. This one I don't know about. Mia, someone
Mm-hmm.
is curious if First American Exchange can help with a 721 exchange.
So yeah, 721, I'm feeling like that. I'm like, is like is it like an upreit, is a DST. So 1031 is a qualified intermediary, and we'll work with a DST, which is a Delaware Structured Trust, and that's where you have fractional interest in a property, which Doorvest, I think you guys do fractional interest also on some things. But 1031 exchange is we are the qualified intermediary with that. And then you identify that DST property that you're going to go into. And then usually a DST meets 1031 requirements because it's fractional interest, but it does not go, but you cannot do a 1031 into basically a REIT. So, anyways, yeah, that's how you make that's how you make a 721 work. And I'm not really good at explaining that one. I'm so sorry. But again, we can email you. I'll email you back if we've got your email on there and get you a strong answer on that one. Okay.
Who I see it as anonymous, but if there's somebody who had that 721 question, if you want to submit your email address through the Q&A, I can make sure
Perfect.
that you're connected up afterwards.
Perfect. Thank you.
And taking a look, perhaps one last one. Let's see here. Someone is curious, Mia, if they could sell an investment property within 3 months of purchase and then exchange for another rental property.
Um, you know, I know that people do it. And as long as I mean, we'd say talk to your tax advisor for sure. Um, and the thing is I know that I've had guys do this because they've closed on something and they're like, oh, but the one I really wanted is available now. So I'm going to sell this one and buy this one, but I'm 1031ing straight into it, and just keeping that daisy chain going because, you know, you're kicking the can on that depreciation and recapture, but if you haven't owned it long enough, it's just kind of building up and you're acquiring more. And so you're going to want to own that next property for a while. And so that you can disperse that out over time, the hit of that if you were to just sell it. So again, always thinking about the end game is always important, and that's where sometimes like, eventually going into something that you can leave to the family, a legacy property, or maybe something you'll eventually turn into a primary residence, or keep, like I said, keeping it as an investment for the for a while. You want to make sure that plays out. So again, it's one of those things, the situation depends on the numbers, but yes, it can be done. You just want to make sure that you got your team all involved and everybody's on the same page. But good question.
Perfect. Sounds like it's possible, but strategy, strategy, strategy. And that's the
Yes, and I feel like we say that a lot.
no, that's awesome. And that's the reason why we want to bring experts like Mia on board to talk and give you all the ins and outs. So it's more powerful but more complicated than you might read at first blush. So hopefully something that where it's a good fit, y'all can take advantage of.
Yeah.
So with that, we'll move to start closing everything up. So first, a very big thank you to Mia and the First American Exchange team. Super experts and some of our favorite folks to talk to about this. And if you ever happen to have asked me about this on a call, then you know that's where we tend to send you. Don't worry if you didn't get a chance to take notes. We'll send a follow-up email with some of the details that we discussed here, including just ways to get in touch with us or with Mia. And of course, if you have any questions, you can also feel free to fire them along via email. We're always happy to help. So a final thank you. Well, you can see here, this is a slide that you'll get in the email, and you can click everything here if you like. But thank you, Mia. Thank you, attendees. Thank you all for taking a little bit of time.
Yes.
Phenomenal webinar.